All right, welcome. Ever heard of Forex and thought it sounded super complicated? Well, in the next 5 minutes, we're going to pull back the curtain on the single largest financial market on the entire planet. It might sound intimidating, but I promise by the end of this, you'll get exactly what it is and how it all works. So let's dive in. So let me ask you something right off the bat. If you had to take a guess, what do you think is the biggest, most traded financial market in the world? I mean, maybe the New York Stock Exchange, right? Or maybe something to do with a global commodity, like oil? You ready for this? The answer is the Forex market. And the number? Well, it's pretty mind-blowing. On an average day, $7.5 trillion are traded. To give you some perspective, that absolutely dwarfs the stock market. We're talking about more money than the entire yearly economic output of most countries, changing hands every single day. The scale is just staggering. Okay, so how on earth do we wrap our heads around a market that massive? Simple. We're going to break it down. First, we'll cover the what and the how of trading. Then we'll look at who's in the market and why they're there. And finally, we'll wrap up with a really important reality check on the risks versus the rewards. All right, section 1. Let's dive right in with the most basic question. What even is the Forex market? Well, at its very heart, it's just a giant global system for swapping one country's currency for another. So Forex is short for foreign exchange, and it's basically this huge decentralized marketplace where national currencies are traded against each other. It's the place you could trade Japanese yen for British pounds or US dollars for Swiss francs, all happening in the blink of an eye. You know, the easiest way to get this is to think about the last time you went on vacation. Remember swapping your money for the local currency? Yep, you are participating in the Forex market. Now, just imagine that, but scaled up to millions of transactions a second, happening all across the globe between banks, corporations, and regular people. Okay, that's the what. Now for the how. How does trading actually work? Don't worry, it all boils down to this one really simple idea: the currency pair. See, in the world of Forex, you can't just buy euros. That's not a thing. You're always exchanging one currency for another. You're buying one and selling another at the exact same time. It's a 2-for-1 deal every single time. And that's what we call a currency pair. Let's take the most popular pair out there, the EUR/USD or the euro versus the US dollar. The first one listed, the euro, is what we call the base currency. Just think of its value as always being 1. The second currency, the US dollar, is the quote currency. Its only job is to tell you how many US dollars it takes to buy that one single euro. Simple as that. So let's put it all together in a hypothetical trade. It all starts with a prediction, right? Let's say you believe the euro is about to get stronger compared to the dollar. Because of that belief, you buy the EUR/USD pair. And what do you know? You were right. The euro's value goes up. To lock in your profit, you then sell that pair to close out your trade. And the difference between what you bought it for and what you sold it for, that's your profit. So who's actually in this market doing all this trading? Well, it's a pretty interesting mix of players, from huge institutions all the way down to folks like you and me. Now, no big surprise here. The giant international banks are the biggest players. They're moving massive amounts of money. But look at this chart. You've also got central banks trying to keep their economies stable. You've got huge corporations that need foreign currency for business deals. You have hedge funds that are purely trying to turn a profit. And then there's this slice right here: retail traders. That's us. Okay, so we know who's playing the game, but why? What's the motivation behind all this trading? Well, it really all boils down to 2 big reasons: protection and profit. Let's start with protection. This is called hedging. Imagine a company in Germany needs to pay a supplier in the US in 3 months. They're worried the dollar might get more expensive, so they can use Forex today to lock in an exchange rate. It's like insurance against risk. Then you've got the other side, speculation. This is all about profit. It's when a trader bets that a currency's value will go up or down, hoping to cash in on that price change. You know, this quote just nails it perfectly. All of that action, those trillions of dollars flying around the globe every day, it's all powered by these 2 very human drives: the need to feel secure and the desire to make money. And speaking of making money, that brings us to our final and honestly, our most critical section. Let's have a little reality check about the risks and the rewards here. Look, the appeal of Forex is obvious. It's a gigantic market, you can get in and out of trades easily, it's open 24 hours a day, and you can make money whether a currency is going up or down. But, and this is a big but, every single one of those perks has a flip side. That high liquidity comes with crazy volatility, and that 24-hour market, yeah, it can move against you while you're fast asleep. But the absolute number one thing you have to understand is something called leverage. It's a double-edged sword. Brokers let you control a huge position with just a little bit of your own money. So maybe with just $100, you could be controlling a $10,000 position. Now, when you're right, that's amazing. Your gains are magnified like crazy, but it works just as powerfully in reverse. One tiny move in the wrong direction, and poof, your entire deposit could be wiped out in seconds. All right, let's do a super quick recap of everything we've just covered. 1. Forex is the biggest market in the world, period. 2. All trading is done in pairs. 3. The players range from massive banks right down to individuals like us. 4. The motives are either protection, which is hedging, or profit, which is speculation. And 5. The most important one, high potential reward always comes with high risk. So there you have it. In just a few minutes, we've demystified the basics of the world's largest market. You get the rules now, you understand how the game works. But that leaves us with one last really important question to think about. Is understanding the game the same thing as playing it? Something to consider. Thanks for tuning in.